right, Ed Yardeni of Yardeni Research is joining us now to take some questions. Ed, great to have you with us here. Thanks very much for your time. You guys enjoyed a nice holiday. So back into the mix today. And the market.
3 days of shopping.
That's nice. And, inflation on Friday once again sort of came in hot, right? The CPI earlier and then producer price numbers as well. What's the sense? I mean, is the overwhelming view, the urge is to just ignore all of this and sort of look at the broader trend, which is disinflation. It's coming. It's a matter of time. But along the way, are there going to be meaningful gyrations from the market?
Well, I think this past week there were some meaningful gyrations in the CPI and the PPI that caused investors to be concerned about whether inflation is going to continue to moderate. A lot of the concerns were about the month-over-month changes, and people went and looked at the details, and some of the details were disturbing. But the Fed can't control what happens to specific items in inflation. It's the overall inflation rate that it has some influence over, and the overall inflation rate continues to come down. The CPI, both core and headline, excluding shelter, is right around 2%. The PPI inflation rate is also right around 2%. So I think inflation is still moderating, but I don't think that the Fed is going to be easing anytime soon. I think they're going to use these hotter than expected month-over-month increases to conclude that there's no rush to lower interest rates. And I agree with that.
Okay. Ed, hi, good morning, and thanks as always for joining us. Back home in India, things are looking extremely good, right? I mean, record highs for the market.
Very good, yes.
Domestic institutions are pumping in money. Should one start to get a bit cautious, or you think that there's more to this rally now?
Well, I think India is benefiting, as we've discussed before, from money that might have gone into China and now going into India. And we can kind of see it in the stock markets, right? The Chinese stock market has been horrible for the past couple of years, and the government finally decided to intervene and provide some support. And that's been sort of fizzled out. It doesn't seem to have really boosted the stock market all that much. And meanwhile, India's market continues to go higher. So I think we can look at the stock markets to get a sense of the kind of the geopolitical developments and how they're impacting the Indian economy versus the Chinese economy. But both the United States and both the United States and India do feel as though they need to take a break here. But they may not. There's so much now interest in investing both in the U.S. and on a global basis, focusing on a country like India, that we may very well see a melt-up in both markets. So that's not something I'm rooting for, because the problem with melt-ups is they're generally followed by meltdowns.
Ed, talking about China, the recent economic data, the holiday spending, the travel spending in the Lunar New Year has beaten expectation. Does that position China perhaps for a tactical rally? And structurally, are you sensing a bit of a change?
Well, I was very interested to see the initial response of the Chinese stock market to this data wasn't all that inspiring. So I'm not sure that the markets over there or investors on a global basis are convinced that just because they traveled more during the lunar holiday and that maybe they spent more in the casinos, that that's going to change the underlying problems in the Chinese economy. And that underlying problem is a serious one. They've got a property bubble that's burst, and we've seen similar situations like that in Japan, in the United States, and it could take 5 to 7 years for those problems to finally be behind them.
And, I came across this statistic yesterday. The U.S. market now is 47% of the world market capitalization.
Yeah, huge.
In 2011, that was 30%. So, it's just incredible, right? And by the way, within the U.S., the 7 large stocks, Microsoft, NVIDIA, Amazon, Meta, Alphabet, Tesla, the Magnificent Seven as they're called, that's 25% of the U.S. market capitalization. So this is some extreme concentration, right?
Yeah, it's very concentrated. And here in the United States, a lot of investors, a lot of technicians and strategists are concerned that it is so concentrated that it hasn't been as broad as they would like. But I've talked to some European investors, Korean investors, others who said, if you look at other markets, they're also very concentrated. So the United States has had a tendency to be very broad, but now it's concentrating to these magnificent 7 stocks. And they're not going to go away. They're making a tremendous amount of money. They are clearly investing in the future of artificial intelligence. So it is what it is.
Oh, absolutely. And your point is taken. World economies are struggling, right? We just heard about 2 of the world's largest economies,
Right.
Japan and UK, announcing recession.
Correct.
And of course, the China property market, as you said, is in a bubble. So it'll always be beneficial for markets like India, perhaps, when investors want to put more money to work. Ed,
Yeah.
thanks a lot for your time. Thank
My
you for your
pleasure.
time and your views. Well, that's the word coming in on the global market.